Well, I thoroughly enjoyed that. Thanks for that breath of fresh air, Joanne. That was fantastic. Thank you very much. I'm glad you went second, because I was about to jump out the window after the first one. So, guys, if anyone's got any questions, I think that we've only got a few people here. So if you want to go to the microphone, please go up. If not, just stand up and announce who you are and which company you're from. And please field the questions to the panel.
Before we do that, Todd, shall we explain what's...
Okay, yep.
Has Wayne got the right answer there?
Here it is.
Do you want to tell us what the right answer is? I don't know what the right answer is.
You don't know? So for our little quiz that we've got, guess the number of Smarties in the jar. I think Paul's got all the guesses there, so he'll be able to determine the winner, but the correct answer was 775.
Okay, well before we announce who won it, you're probably wondering what this has got to do with what we've been talking about today. One of the big misconceptions, I guess, in the markets is that it's all about trying to choose a particular stock at a particular time. Historically, it's been proven that trying to work out whether Apple is better than Samsung or vice versa actually doesn't make a great deal of difference to investment returns. It's what everybody focuses on. It's what all the TV channels that are kind enough to let me go and spend hours whittling away, it's what they all focus on most of the time. But it's actually really got very little to do with investment returns. Investment returns are 90% driven by asset allocation, i.e. deciding, do you want to have equities or not? Do you want to have bonds or not? Rather than the details of which equities or which bonds are the right one to have. Which probably makes you wonder why we've got a jar of M&Ms here. One of the reasons why it's so difficult to succeed at trying to guess which equity is going to outperform is because whatever information we may feel we have, whatever edge we may feel we have over everybody else in the market, most people are actually looking at the same information. And so when we ask people to have a look at, have a guess how many M&Ms are in here, everybody's actually looking at the same information. And so the range of answers that we got was actually pretty similar. There are a couple of fairly extreme ones, but most of the answers that I'm looking at here, 870, 850, 364, 482, 600, 1,000, 500, 648, they're all roughly in the right kind of range. And that's because we're all intelligent people. We can all look at this and make a reasonable estimate of how many are in here. In the same way, we can all look at Apple, Samsung, Google, and make a rough estimate of what we think they're worth based on what we know. So, probably one of the biggest wastes of time. It's a huge amount of fun. It's really interesting, but one of the biggest wastes of time from an investment utility point of view is the amount of time that's spent on individual stock picking. I mean, how much of your time do you ever spend worrying about individual stocks? Hardly any. Never at all. And that's because...
But I would argue, I think that, I'm not trying to argue with you too much, but I think in certain sectors of the economy you do want a stock picker, because particularly in emerging markets and in small cap stocks, I think the reason developed market fund managers struggle to outperform the indices, and I think the number you quoted me was 75% of people don't outperform the S&P. I think that's exactly your point about when you have a lot of data in front of you, it's very hard to outperform because everyone's looking at the same data. The difference in emerging markets, and particularly small caps, is not everyone's looking at the data. And that's why there's the potential. There's only 2 people looking at the jar as opposed to 40 people looking at the jar. And when you've got opportunities like that, you can actually make money as a stock picker.
I'd agree with that.
I think it depends which, it depends which you're looking at. So most of the time we buy ETFs. I think I would agree with Paul on that. Asset allocation is more important. But there's definitely, if I'm in an Indonesian fund, I want to know that the manager knows what they're doing. Okay, admittedly we don't buy Indonesian funds as an example. We buy an emerging market manager will buy the range of Asian funds. But I want to know then I'm getting somebody who knows what they're doing, because every region is going to be different.
I totally agree with that. I mean, in most markets, certainly major markets, the point about this is that ETFs, exchange-traded funds, which just replicate the market, are a much better idea than the 75% of funds that underperform. In Thailand, for instance, the story is different. Our preferred Thai fund manager achieved almost twice the index last year. He got in the high 50s, whereas I think the index was 33 or 34, something like that, and he's up about 20% so far this year, which is again some way ahead of where the index is. So sometimes you can get an information advantage, but it's very, very unusual. But we should... Who won? So 700 and...
775, I think.
775, then the closest one is... See, I would have known it would be somebody from an accounting firm. That was inevitable, really, wasn't it? Mr. McBean, could you come and claim your prize? Don't eat them all at once. Okay, now that we've got the slapstick out of the way.
Any questions?
Shut them up.
They're either depressed or stunned or...
Joanne, have you got any views on... I know you don't like cash as an asset, but you're a US dollar-based fund, that's correct. What other currencies do you think have potential growth against the US dollar, therefore?
Mexican peso looks quite interesting to us. I find it quite ironic that a lot of people now are leaving America and going back to Mexico. And the car industry is doing quite well because the Americans are buying cars again, and they're buying them from Mexico. And it's a transportation issue, so they're close to their market. So Mexican peso looks interesting to us. Yeah, possibly the Canadian dollar. We're quite potentially positive on the oil price. I think the oil price will go a bit higher. And euro, I want to short euros and I want to short the yen. So those are big, and short sterling, because that's not too hard a call because everyone's so utterly depressed and the housing market's falling. But yeah, so we like dollars. That's kind of it is harder for us in an environment where the dollar's strong to make money because we can't get those easy gains that you get from other currencies. You know, if you're a sterling-based investor and your currency is weakening, you get not only do you get the returns of that asset class with the right asset class, but you also get the currency advantage. So it is more difficult in a strong dollar environment. You know, the dollar, I mean, there's some stats I didn't give today, but I think exports in the euro are up a third since 2007. We've had a weak dollar that's helped them. Exports now, I think, account for 20% of the US GDP growth rates. It was 14% not that long ago. So a weaker currency does have its advantages, but I think if you look at the fact that we think the current account deficit will start improving and sort of make it locally, and there's another interesting thing that's happening. We spoke about it earlier. Asia is very exciting, but wages have gone up here. And what you're starting to see, very slowly, but you're starting to see a lot of companies moving businesses back to the US because you're close to the consumer, and through robotics, it's almost cheaper now than to hire the Chinese to do some of the work. So you're starting to see it kind of bring it back to America, and that should also be broadly positive for the dollar.
I think the interesting thing about the dollar is that it's probably the one thing we agree on, really, for different reasons. That's unfair. There's a lot of things we agree on. But I think the great thing about the dollar is that if you are a growth investor and you're looking for a lot of the stories that Joanne's talking about to actually occur, then you want to be in dollars. If you're a defensive investor and you're very worried about some of the things that might happen, well, it may well be that the US is at the epicenter. It may well be that the US debt problem, the $86 trillion, is the cause of it. But you know what? Dollar is probably still going to be one of the main beneficiaries. In 2008, we had a US bank go to the wall. In 2007, we did as well, I suppose. But we saw all the consolidation in the US banking sector. We saw TARPs and TELFs and QEs, and yet, you know, the place where everybody ran to was the reserve currency. They ran to the dollar. So I think if we get a crisis, we expect to see the dollar strengthen a lot. And if we don't get a crisis, then that's probably because we're seeing a lot of US growth. So we expect to see the dollar strengthen a lot. So I think wherever you are on the risk spectrum, dollar is actually a fairly good play. It's one of the few things that works up and down the risk spectrum.
And I certainly wouldn't be long the rand if anyone's asking your views on that. South African currency is a bit scary at the moment, so I wouldn't be along that currency.
I think locally probably people are more concerned with baht versus dollar than...
What is the view on the Thai baht? Does anyone have a view on that?
At the moment we're going through, I don't know if anybody's been tracking this, and actually be interesting to get some views from the floor, but one thing we've noticed is that since August or September, the foreign exchange reserves, the Bank of Thailand's foreign exchange reserves, have been declining, not hugely, but noticeably. And what that means is that the traditional policy of sterilising foreign inflows has basically gone into reverse. Now, we know that there's a lot of tension between Bank of Thailand and the Finance Ministry. We've got a you've got a government here that seems to think that the Western blueprint from 2000 up to 2008 is a great idea and we ought to be copying it. We've got a central bank that is a lot more conservative than that and sees all the dangers of it. And so I think one of the tensions that we're seeing is central bank is pushing back against government policy, but basically completely undermining it. It seems to deliberately, we can't think of any other reason for it, and this is why, again, I'd be interested in some thoughts on the floor, but the only reason we can think of for Bank of Thailand to deliberately force so much strength into the baht is because Dr. Prasan is very, very keen to push back against a lot of the expansionary and counter-cyclical stimulatory policies that are coming out of the MOF, and that becomes a very difficult one to call going forwards, because who are you going to pick to win? The finance minister with all the weight of the government behind him, or the Bank of Thailand governor? And we have seen Bank of Thailand governors removed before, but it's a very difficult process. It is very institutional. It'll be interesting to see how that plays out. Learned table on the right here. Have we got any other thoughts on what is happening and why?
What's your view on commodities?
We've turned less bullish on commodities, and we think the next cycle belongs to equity markets, and it's hard to be bullish on commodities and bullish on equities in the same breath because of margin pressure. If commodities start rising in price, you've got companies struggling. We also think, unlike Paul, that we think China is changing their type of growth that's coming out. I think they are trying very hard to get a domestic spending focus. And the numbers I saw last year, domestic spending was greater than infrastructure spending. And there are two arguments too. China's changing their type of growth, but more importantly, it's a mean reversion argument. The last 10 years, you've had phenomenal returns in commodities just across the board. I think the next 10 years, if you look at historical cycles, you tend to have another 10 years on top of another 10 years. So, there is a certain price point that commodities have to slow down. And we're also starting to see more supply come on board. We've had a demand story that everyone knows about, but supply story is coming on board. So my feeling is, if you buy commodities, be very selective. There are going to be pockets of commodities where there is a massive supply-demand gap. Platinum having been a good example recently, where I think people were all very aware of the fact that there was auto-catalytic converters in Europe were slowing because people weren't buying cars, so the platinum prices dropped. But then we had all the problems in South Africa with the platinum mines, and Anglo Platts talking about cutting the job force by 14,000 and cutting the supply of platinum. And then suddenly we went from a sort of a surplus situation to a deficit situation. South Africa being the biggest supplier of platinum in the world. And so it can change very quickly, but my point I'm trying to make is, as an asset class, I wouldn't buy it for beta anymore, I'd buy it for alpha, selectively choose certain assets. Like natural gas could get very interesting. Natural gas is unbelievably cheap. I mean, what the Australians sell natural gas to China for is about 3 or 4 times what the US are producing at the moment. Now, there's a whole fracking issue behind that and the pollution impact, but natural gas is incredibly cheap, and it can't stay much cheaper for much longer, I don't think. So oil's interesting. I mean, I agree with Paul on his geopolitical risks. There's always something bubbling away in the Middle East that oil can do that. But having said that, if you look at the problems of debt in the US today, it's a question of they've spent too much money. But I think it's the 1st of March, we're going to have automatic cuts on spending that's going to go through, and a large part of that will be defence spending. Now, in the past, the Americans you had to have all this money on defence, but I think if they become oil independent, there's less reason to have a huge US military, which can suddenly cut those debt problems down a lot. They can cut that spending. And the other thing we didn't talk about today as well is that people love to show, debt levels and what's going on, but why do they never show the asset levels? I own a house. I don't go, my debt level is extreme. I go, I have a house that's got an asset value of X, a debt level of Y, and I got positive equity. We only ever see on all those graphs of how terrible governments are. Italy's a brilliant point. Italy has incredibly high debt levels, but if you actually look at the asset levels behind it, Italy's in great shape. Fiscally they're not, but from an asset balance sheet perspective, they're in good shape. So be very careful of what economists will show you. They want to show you a dire, awful picture of the world, but they don't always give you all the facts.
But to be fair, I did talk about net worth in the States, which is...
You did. But net worth, if you look at the breakdown of net worth, if the US housing market picks up, it's a greater multiplier than the stock market.
It is.
And I can't remember the numbers off the top of my head here, but in the gains we've seen lately, net worth in the US is massively improved recently, and it's not been from the stock market because, you know, the stock market's been quite tough. It's actually been from the housing market. That's a bigger, because I mean, US people don't save money, so the stock market might go up, but if you're not in it, you're not going to make money out of it.
And even
but
if you are in it, you're not in it 5 times levered. So.
No, exactly. Yeah. Well, hopefully not the case, but yes.
But I think one thing about commodities, well, I agree with a lot of what Joe said, but the one thing I would say is, you know, commodities are not an investment asset. Investment assets are things that either appreciate or they maintain their value and they pay you a yield. Commodities do neither of those. Over time, historically, commodities depreciate in real terms. So the only investment opportunity with commodities is really typically very, very short-term, very tactical. It's very difficult to play that. It's very specific geopolitical situations, and I think, you know, when those situations arise, you can actually look at what what opportunities commodities afford. And I think one of the most interesting things at the moment may well still be copper. And I think a lot of defensive investors need to be looking at being short copper. I think it's still an interesting play. Maybe a little bit early right now because there is so much liquidity flying around, but the minute we see that liquidity drying up, I think short copper could be the most interesting commodity play of the year.
I would agree with Paul on that. I think that's quite a good risk diversifier in your portfolio to be able to short copper. I think, back to your commodity question, we've had sort of 10 years of phenomenal growth from China, and your point is very valid. Commodities are essentially, at the end of the day, a mean reversion play. They don't give you a yield, and after you've had great returns, they tend to go back to the mean again. But you can't let commodity prices go on forever. But having said that, I think there are certain parts of the commodity spectrum that do have huge supply-demand imbalances.
Do we have any Thai baht thoughts from over there?
As I said, I think the conflict you have with this is short-term because of the volatility of cash flows that we show with the change from equity funds
Yes.
to cash to equity funds.
Yes.
So the bank account is short-term. But long-term the must appreciate it because they're growing economic uncertainties. If you constantly run currency uncertainties, by default the currency has to increase.
Unless you sterilise it all.
Yeah, but it may overshot in the short-term.
But it's interesting they've gone into reverse sterilisation. Yeah? You don't see any underlying political motive or anything like that? Okay.
There's been massive inflows into emerging market funds. Huge, huge inflows.
Okay. So I'm looking for a conspiracy theory where there isn't one. Yeah.
And FDI flows into Thailand, what's that be like?
Very strong. FDI has been good, bond market's been good, equity market's been good. I mean, it's coming into all sectors. Yeah.
Well, this place is definitely humming. I've never seen traffic like this in my life. I thought Indonesia was bad.
That's because there's a government program to go and promote buying cars at the moment. Now that we have Detroit of the East, then, you know, we're using that by putting money into people's pockets as long as they buy cars.
Or conversely, we could say people are feeling positive about the future and have bought a car because they want to have a job that's paying them money and they want to drive somewhere.
I think the subsidies more. And
I believe there's also the downside is people are taking loans to buy cars because I can get 7,500,000 baht back from the government.
Yeah. Oh, are they already?
intertemporal dislocation.
So I can't speak for Thailand, but in South Africa we've got quite low debt levels because what happens, it's very difficult to borrow money. So you've got to be able to conclusively prove you can pay it back. I mean, I don't know about Thailand's borrowing story.
I think one thing that's worrying here is you see sovereign debt. I mean, consumer debt, corporate debt, sovereign debt, they're all on the increase. But, you know, one of the things that worries me is with the current policies we've got, we've seen Thailand and Indonesia go from a very similar base to a situation where we're now looking at Thailand approaching 60% debt to GDP and Indonesia still down in the low 30s. It's not feeling the need to play the same game.
Because the currency being too strong. Yeah.
I think it's a very dangerous game that they're playing.
The other thing I think in Thailand, which I don't think a lot of people are aware of, the debt figures seem to run through government policy rates.
Yes. Yes.
Government funding projects, first car, lower home,
the commercial banks, yeah, correct.
And also there's some statistics.
And also, obviously, it's not including the forward commitments, so we're only counting, 10% of the wastewater project so far, because they can't actually roll it out as quick as they'd like to. I agree, I think there's a lot of scary things happening in Thailand that probably shouldn't be happening, aren't entirely necessary, and if we're not careful, the fact that Indonesia and places like that, even the Philippines, are pursuing in some ways more conservative monetary and fiscal policies is a little bit worrying for Thailand. I suppose 1997 was 16 years ago, so we've all forgotten by now. Are we?
Guys, I think people have got to get back to work and things like that, but Joanne and Paul will be around for a little while, I think, if anyone's got anything specific. Today was a debate, so let's just do a quick show of hands for who won. If you if you believe that cash is king and capital preservation is key, can we have a show of hands for Mr. Gambles?
Hang on, can I say something?
Yeah.
On what time frame? Because I think no, but I mean we've had a great debate here, and I think people all have their own financial what they need to get out of markets. So if you're a conservative investor and you don't want to lose money in the short term, then clearly my view of the world is never going to be appealing. But if you have can we say in the room we all have to have long-term views?
Okay.
Well, I think that's a really key point, because I mean, if you look at where the set is right now, around about 1,500, say, for round figures. We've got a 10-year view that we expect the set to be somewhere fairly broad range between 5 and 10,000, probably say 7,500 maybe. So we were expecting fairly significant long-term appreciation out of the set. So why wouldn't you buy it? Well, for a lot of our clients, for a lot of our investors, the reason we wouldn't buy it is that over the next year or two, we're also expecting to see the set go to something like 750, and that's when we think we would buy it, because that's when it stops having so much risk and downside in there. So if you're a long-term buyer, simply looking point to point, if you're going to put the stock certificates in the drawer and never look at them, then for 10 years you should just be buying the most aggressive emerging markets right now. If you're worried about what the path is between point A and point B, that's when maybe you need to take a more conservative view. So you're right, I mean, a lot of it is about risk appetite.
It's about your time horizon, because in the short term I think it's too difficult to call, but I do think you're being paid to take the risk of equity markets, you're not being paid to take the risk of bonds.
Agree with that, totally agree with that.
We're agreeing with each other.
That's not a debate. That's not a debate. So it's a short term that we differ on then. So
they've ended up agreeing.
We think that the long term is going to play out the same.
Okay, let's simplify it. Show of hands for Paul. Show of hands for Joanne. A clear winner. Guys, thank you very much. As I say, if anyone's got anything specific that they want to speak to them about, Joanne and Paul will be around. But on behalf of MBMG, thank you very much for coming today.
Thank you. Can I just say, I was tempted to vote for Jo, because I actually hope she's right and I'm wrong. So.
I know, I hope you're wrong.